Welcome to the 23-24 Locum Tenens tax webinar. I am your host, I guess, Stacey Sear. I'm the Director of Marketing for Barton Associates. We're the fourth largest locum tenens staffing agency in the United States. We place MDs, MPs, PAs, dentists, and CRNAs across more than 120 specialties. We place them nationwide. So we are partnering with Andrew Schwartz, who is going to share with you everything you need to know about taxes as a locum tenens provider. And all of this will be recorded, and we'll have this available on bartonassociates.com in the next few days, and it'll be available also on our YouTube channel as well, and it'll also be available on Andrew's website. Andrew, do you want to introduce yourself?
Sure. Yep. Thank you, Stacey. My name is Andrew Schwartz. I'm partners with my brother Rick Schwartz and the CPA firm of Schwartz & Schwartz. We're based just north of Boston, in a city actually called Woburn, Massachusetts. We have a very narrowly focused niche practice. Pretty much 100% of what we do is in the healthcare space. We're starting the tax season. Each winter we do probably about 2,500 personal tax returns for physicians, dentists, and psychologists and other healthcare providers. So we're very familiar with the tax issues affecting you and your colleagues. And over the years, we picked up a bunch of people who are doing locums type work. And this webinar that I put together today for you guys kind of summarizes and highlights the issues that you probably want to be familiar with to minimize your taxes and do some basic financial planning steps as well. So let's get right into it. So let's start out with, whoops, one sec. Is this thing going to work here? Okay, so here's what we're going to discuss today. We're going to start by talking about common deductions for locum tenens participants. Then we're going to talk about retirement plans. That's very important for people during their working years. We will then discuss health savings accounts, which are getting more and more popular and for a very good reason. Talk about paying your estimated taxes. Thanks to the 2018 tax law change, there's this new qualified business income deduction, which people can claim who are self-employed. We'll talk about some planning, and then we're going to end with some state tax concepts and S corporation consideration. So that's it. Stacey's going to keep an eye on the chat. So if anybody has a question or you're not sure what exactly I'm talking about, I'll put something into the chat. I do have content to fill pretty much the whole hour. So it's going to be tough to take those questions real time, but we'll do the best that we can. All righty, so let's jump right into it. So the first thing we're going to talk about is deduction. So when you work as a locums, for the most part, especially when you work for Barton Associates, when they pay you as a 1099 contractor. Okay, so they don't pay you as a W-2 employee. They pay you as a contractor. I just want to make sure. Okay, great. So what that means is you get paid as a 1099 contractor, and then you're allowed to deduct your professional expenses, your unreimbursed professional expenses directly against that income. So let's say you work for Barton and you make $60,000 during the year, and you're able to come up with $10,000 of unreimbursed professional expenses to deduct against that $60,000. When that's the case, you're only taxed on $50,000 of your net income as working as a locums. Okay, you get your 1099. And then you go through the next step of deducting expenses directly against that income. For professional expense to be deductible, first of all, it can't be reimbursed by Barton or by anybody else. So it's only expenses that you actually incur out of pocket. But for the expenses to be deductible, they need to be both ordinary and necessary in connection with your profession. All right, so if you buy a laptop that you're going to use in connection with doing your work and keeping your schedule and communicating and whatnot, I would say that a laptop computer would qualify as ordinary and necessary. If you buy the Coach carrying case for your laptop, you might think that's ordinary and necessary, but under audit, the IRS might not think that a $500 or $600 carrying case, if that's what it even costs, would be ordinary. Okay. So we're going to touch base on health insurance, which actually you write off, but you don't write off directly against your 1099 income. And then we're going to talk about travel, lodging, and meals, automobile expenses, and then education, licenses, and examination. So let's take a closer look at these deductions, which are going to help you save some taxes. Okay, so all right, first off, let's talk about health insurance. So this is great. If you get paid as a 10 and you're paying your own health 100%, where you write it off on your tax, your 1099 income, but it is 100% deductible. Now, for it to be deductible, you can't have access to health insurance through another employer or through your spouse. So if you have access to health insurance and you just opt out to buy your own health insurance, I don't know how the IRS would ever know that was the situation, but you're not supposed to deduct your own health insurance premiums in that situation. But here's a very important point. If you're 65 or older, or married to someone who's 65 or older, and they're on Medicare, those Medicare premiums that are paid, even if it's paid out of Social Security, those Medicare premiums are deductible as a self-employed health insurance premium. Okay, so if you pay your own health insurance, or if you or your spouse are on Medicare, those premiums that you pay are 100% deductible against your income, to the extent you have net self-employment income as a 1099 contractor. Okay, so that's great. Deducting health insurance is a really good thing to do. I don't know if you've noticed, but we provide health insurance to me and my brother and our staff. It keeps getting more and more expensive, and it's great to be able to deduct things that as they get more expensive. All right, next up, let's talk about travel, lodging, and meals. One of the beauties about doing locums type work is you get to travel to all different parts of the country, and I guess maybe the world. And you want to be able to deduct your unreimbursed travel expenses. So I think that Barton's pretty good about reimbursing for travel and lodging, but whatever they don't reimburse you for would be tax deductible. Now, here's the rules. Whenever you're living and working in one city, one metropolitan area, and then you go to live and work in a second metropolitan area, and the assignment is supposed to last for a year or less, then that whole time you're on that assignment, it's treated as one long business trip. Now, I do need to add, you're living and working in one city, you go to another city for a year or less with the intent of returning back to the first city. That's important too. So you need to be living somewhere, move somewhere for a year or less, and return back to the original city. If you go from city to city to city, you're considered a transient employee, and then your travel, meals, and lodging wouldn't be deductible. But if you do meet the thing where you're doing an assignment for a year or less, keep track of those plane flights, keep track of the hotels or the VRBOs or wherever you're staying, that you're not being reimbursed for, and that's all deductible. You can also deduct your meals while you're gone. For the past couple of years, you could deduct 100% of the cost of the meals, because that was after COVID. They wanted to give people incentive to get back to the restaurants, but now the meals are 50%. It's 50% deductible whether you claim your meals based on the actual cost of the meals over the term of the trip, the temporary job assignment, or if you base it on the per diem rates. Now, if you're on a business trip and you go into somewhere that's expensive and you're there for like a week or a long weekend, you might be better off claiming the deduction for your meals based on actual expenses incurred. If you're going somewhere for 6 or 7 months, you're not eating out that often, you're better off basing the deduction on this thing called the per diem rates. Now, the per diem rates is a situation where the government made things easier for us. You're allowed to deduct the cost that you're allowed to deduct the deduction for the meals, whatever, based on a daily rate. And if you go to this place called gsa.gov, it's very easy. Let's see, here's gsa.gov. If you scroll down, and let's say you went to Colorado, and you went during 2023, you went last year, and you want to know how much you can deduct per day, that's all you need to do. And if you went to Denver, where's Denver? Anybody? Here it is, Denver. Oh, we don't want this. Here's the meals and incidental. For Denver, you get to deduct $79 per day last year. So if you went and you were there for 3 months, and you basically stayed there the whole time, you would get to claim a deduction for your meals equal to 50% of the 90 days you were there times $79. So, you know what I mean? There's no way you're going to spend that much at restaurants over the course of 90 days. So you would just base it on the per diem rates. And very important, as I said, there's two ways you can claim the deduction. One is on actual expenses incurred and the other is on these per diem rates. You need to be consistent per trip. So during the course of the year, you can use both methods, but you can only use one method per trip. And if you're lucky enough to travel outside the US or to Alaska or to Hawaii, you would base your deduction on this thing that I have a link right here. And this gives you the same thing for foreign travel. So all the information you need is right there. You just click and indicate the place where you went. Not bad, huh? That's a good start. Okay, moving right along. The next thing we want to talk about is automobile. That's a great deduction. So automobile miles driven are deductible if they are miles for driving between job sites, driving between your home and a temporary job site, right? So locum tenens between a temporary job site and traveling to interviews and conferences and things like that. Driving between your home and a regular place of business isn't tax deductible. So the temporary job site is when you're living somewhere, you go to another place for a year or less with the intent of returning home. So driving between your home and that temporary job site would be tax deductible. There is one more requirement, and that is it's basically not possible to wake up in the morning, drive to where you're doing your locums, work all day, and return without first needing to rest. So if you can drive from your home to where you're doing the locums and then return home, you don't have a temporary job assignment. You're still within the general vicinity of where you live. But if you need to rest before coming home safely, then you are in a new metropolitan area, and your travel becomes deductible. And same with your car expenses. The other important thing to note is the job assignment has to be for a year or less. The day you find out that job assignment becomes indefinite, or the day you find out that job assignment is going to last more than a year, that's the day that you can no longer deduct your travel, your meals, your lodging, and any of this mileage that you drive, driving between and also driving around its position, because it's seen as one big business trip. There's two ways to deduct your mileage. One is you base it on the standard mileage rates, and the standard mileage rates for 2023 were 65.5 cents a mile. For 2024, it's going to be 67 cents a mile. So all you need to do is you tally up the total business miles you drove during the year, and you multiply that by the standard mileage rate of 65.5 cents a mile last year, and you come up with the answer. The other way to claim your automobile expenses is based on actual expenses incurred, and actual expenses include gas, insurance, repairs, parking at home if you have to pay for parking at your house, and lease payments if you lease your car, or a factor for depreciation if you own your car. And here you base it on the percentage of the miles driven during the year that are business miles. And as a rule of thumb, unless you drive very few miles during the year, with most of those miles being business miles, you're better off going with the standard mileage deduction. There is one exception, and that's if you buy one of those big SUVs with a gross vehicle weight of more than 6,000 pounds. In that case, you get to basically take the business percentage that you drive the car during that year and multiply it by the cost of the vehicle, and you get that huge deduction. There are some pitfalls with that. You do need to keep the car in business use for 5 years, more than 50% business use, or you have to recapture some of that big depreciation deduction you claimed up front. So if you drive a lot of miles, you're usually better off just basing your deduction off the standard mileage rates. If you drive very few miles during the year, with most of those miles being business miles, go through the exercise of tracking your car expenses and then claiming the deduction. Okay. And lastly, let's talk about education, license, and examinations, because this is important for people who are locums. So basically, the rules say that anytime you do something that qualifies you for a new trade or business, the costs associated with that would not be tax deductible. So that's medical school, PA school, undergrad, getting your RN, all that stuff, dental school. All those costs are required to qualify you for a new trade or business. So those aren't tax deductible. Same goes for licensing exams. So the first licensing exam you take that qualifies you to practice in a profession, that's not tax deductible. But any subsequent licensing exam, so if you have to renew your license, if you need to pay to get licenses in other states, all those costs of getting those subsequent licenses are all tax deductible. And then there's some other things as well. So if you're in mental health and you are paying for psychotherapy as part of training to become a licensed psychotherapist, or you're paying a therapist to help with supervision and things of that nature, all those costs, that out-of-pocket costs, not the ones not covered by insurance, but all those costs are deductible. If you're a licensed healthcare practitioner and you're getting your MHA or one of those master's degrees to help you be a better provider, those costs, instead of qualifying you for a new trade or business, they enhance your skills in your current trade or business. So anytime you do something that enhances your skills in your current trade or business, that is deductible. That's a psychotherapy for the therapist. That's the some of these master's programs. Any dentists who are doing a specialty program, the cost of the specialty is deductible to a practicing dentist. If you get a 1099, you write off the tuition for your endo program, your ortho program, perio program, right against a 1099 income, even if you come up with a loss. So there are a lot of opportunities for healthcare professionals to deduct the cost of some of these education licenses and exams. And as I said, we typically, when you get a 1099, you don't want to show a loss. We have people who, especially dentists who are in specialty programs, we have shown a loss. We've shown expenses exceeding income. They've been audited. We've explained to the IRS what's going on, and we've been successful each and every time. All right, so that's a section on common deductions. Let me just see if there's any questions I can answer real quick. If my wife pays insurance to a company, we live in a community property state, can I deduct it on my taxes? I don't know. So there's 5 or 6 community property states. Massachusetts isn't one of them. So unfortunately, I don't know that answer. If you go to and from your tax home to different cities, would those expenses be deductible? Your tax home is where you live and work. If you go somewhere for a year or less with the intent to return and back to where you live and work, your tax home doesn't change, actually. You're on a big business trip. Once your tax home changes, you actually can't deduct business expenses unless you're working at 2 different locations. If your assignment is over a year, is there any amount, I can put this right here. Is there any amount of revenue you can do in your home location to keep you from losing your tax home? If you're going to be somewhere for a year or more and you continue to work where your tax home is and also at the second location, and both of those jobs are meaningful, then the travel remains deductible, because you have to travel to work. You have to pay for travel to work at both locations. You can't just work at one location. So if you don't keep working where your tax home is, then the place where you are for more than a year actually becomes your tax home. Does this include spouse? No, I think for Medicare, yes, it does actually. Is it 50% of the per diem rate? Yes. So you calculate the deduction for your meals based on your per diem rate, just as you claim the deduction based on actual expenses incurred, and then it would be 50% deductible. And last but not least, in a rural area, no, if you look at what I put there, they actually have, in the per diem rates, they show if it's not one of the cities listed. Let's just see real quick. Let's go back to Denver. Where is this thing? Oh, okay. And then I got to go to the next section. Okay. So we go to Colorado. If we do 2003, if we search, I thought it showed everywhere else. Oh, the standard rate, right? You see this? If there's not a specific rate mentioned, then you go with this amount. So Denver is 79, but if it's not one of these cities, it's $59 an hour. Okay, great questions. Okay. Okie dokie. So let's talk about retirement accounts. So when you get paid as a 1099 contractor, you have the opportunity to set up and fund and deduct contributions made to a certain type retirement plan. The most common examples are SEP IRAs, simple IRAs, and solo 401ks. And for people later in their careers, or people who are can afford it, this type of plan where you can put away a ton of money, called a defined benefit plan, that only works in certain situations. But let's talk about how great saving for retirement is. So let's say you're in the 28% federal tax bracket and the 5% state rate in the state where you live. So that's a combined 33% tax rate. So if you're in the 33% combined federal and state tax bracket, and you put away, for every $1,000 you put into your retirement plan, you save $330 in taxes. So it only costs you $670 to have $1,000 growing. So you already earned $330 on your $670 investment, right? So you put away $1,000, the government gives you back $330 in a tax savings. It only costs you $670 to have $1,000 growing tax deferred. You've earned $330 on your $670. You earned a 49.25% return on your money. Now, if you were invested in the S&P 500 for the last, I don't know, 20, 25 years, let's say, the S&P 500 are the 500 most successful companies in the United States based on market capitalization. So if you invested in the S&P 500 over the last 25 years, you probably got a 10, 11, maybe a 12% return on that investment. I'm telling you how you can get a 49% return on your money, and that's by taking advantage of the tax savings. Now, yes, of course, you do need to pay taxes on this money when you take it out later. So it's temporarily a 49% return on your money. But what you can do is you take that tax savings and you invest the government's money in your retirement account, and you hold on to that money, and you keep the compounded earnings on the tax savings that you realize. So for every $1,000 you put away, the government's letting you hold on to $330 and invest that $330 and keep the compounded earnings on that $330. That's the benefit of a retirement account. Putting money away into a retirement account during your working years is one of, or the best tax shelters available to working people. Anybody who's worked for a number of years and has put away money diligently every year, you know what I'm talking about, right? The money grows and grows, and it actually grows exponentially. And holding on to the tax savings that you wouldn't have had if you didn't do the retirement account just makes it a huge home run. And it's something you want to do. So with a SEP IRA, you can put away 20% of your net 1099 income after writing off your expenses. A simple, you can do $15,500 or $19,000 if you're 50 or older, plus 3% of the net 1099 income. Solo 401k, listen to this, you can put away $22,500 for 2023, or $30,000 if you're 50 or older, plus 20% of your net self-employment earnings. If you earn $50,000 and you're 50 or older, you can put away $40,000 pre-tax into the solo 401k. So there's all these options out there. The information is available online. You can look at Fidelity, Schwartz, Vanguard. If you use an investment person, they can help you. But taking advantage of these retirement plans is a great way to save taxes, just like writing off expenses against your 1099 income is a great way to save some taxes. Okay. So another great way to save taxes, especially if you have to buy your own health insurance and you're reasonably healthy, is to put money into this thing called a health savings account. So these are getting more and more popular. These came out under George W. Bush when he was president, so they've been around for a while. So basically, you can put money into a health savings account if your health insurance is a qualified, high deductible health insurance plan. So Medicare doesn't count. Medicare definitely doesn't count. But if you have to buy your own health insurance and you find one, normally it has the letters HSA in the name of the policy, or you can ask whoever you're buying the policy from whether the high deductible health insurance plan qualifies for you to put money into an HSA. It's a great place to put some extra money. So let's take a look at all the great things that happen when you have a health savings account. So first, any money contributed into a health savings account goes in as a tax-deductible contribution. If you ever worked somewhere that had a health savings account, you may have noticed that the employer put away some money into the health savings account on your behalf. Health savings accounts can be funded by either an employer or by the participant. It doesn't matter, and the money goes into the same account. So if you're self-employed and you don't have an employer, or you're your own employer and employee, you would fund the health savings account yourself, and you would put away that money on your own. For 2023, for a family plan, you can put away $7,750. For an individual plan, you can put away $30 and put it in here. Anybody 55 years or older can put away an additional $1,000 into the health savings account, and that money goes in pre-tax. It's tax deductible. The money that's invested in the health savings account, there's no use it or lose it provision like there is with a flexible spending account. So with a health savings account, you can keep the money in there year in and year out. It's another place to grow out, to build up a nest egg in a tax advantaged account. So you put away the money, you get a tax deduction. The money remains in there. Any money that comes out to pay for your family's health care costs comes out tax-free, which is great. So this is the only place I know where you can put away money that's tax deductible. Money comes out tax-free, and any money sitting there once you turn 65 that you can't spend on medical expenses, which I kind of find hard to believe. I'm 58 and I'm already seeing how expensive healthcare is going to get. Any money that you take out that's not absorbed by health care costs, you can still take the money out once you're 65. You pay income taxes on that money, but you do not pay the 10 or the 20% early withdrawal penalty. So it's great. Now, what a lot of people do, if they have some extra money, is they'll put the maximum amount of money into the HSA each year. They'll get the tax deduction. And then when they have a medical expense to pay for, if they have money in their checking account, they will just pay for the health care cost out of their checking account, and they'll keep as much money as possible in this beautiful tax advantage account, growing tax deferred, sitting in some great mutual funds, either Fidelity or Vanguard or Schwab. If I get this one newsletter on financial planning for dentists, this guy says that Fidelity right now is the best place to put your HSA money. So you put the money in, the money continues to grow tax deferred, and it'll just be another place where you can fund your costs, your living costs when you retire. Health savings account. So first figure out if you have a qualifying high deductible health insurance account, and then figure out how to set up a health savings account. And that is the winning combination. As far as healthcare, for 2024, the amounts are increasing to $8,300 can get contributed into a health savings account for families, and $4,150 for individuals. And the amount for anybody 50 or older stays at $1,000. If both of you are over 50, you and your spouse, you actually each need to have your own health savings account to each be able to put away $1,000. Okay. There's actually a lot of questions. Let's see. We'll just go through some. Let's see what we got here. In a rural area, is paying for an accountant tax deductible? Yes. When you do your locums, you would pay for the accountant, and the accounting fee would be deductible on the Schedule C, which is the tax form where you report your 1099 income and expenses. Car insurance premiums, we talked about auto expenses. You either base it on 65.5 cents a mile or on actual expenses incurred. Are these deductions only apply if you're a 1099 employee? Yes, that's right. So to deduct these expenses, in 2018, when there was this big change to the tax rules, one of the changes was W-2 employees can no longer deduct their unreimbursed employee business expenses. The only way you would do it is you would have your employer pay those expenses and just get paid less money, okay? Continuing education, yeah, that's deductible. I would say that qualifies as ordinary and necessary. If I'm part-time dental locum, it's a deduction limited. So here's a little bit complicated. So I guess you're asking if you get a W-2 and you also get a 1099, whether you need to prorate the expenses. We don't do that here. We'll take the expenses directly against a 1099 income. We will not bring the 1099 income to a loss. That's one of the areas where the IRS is actively auditing people, is if they have a Schedule C, the business or loss from their income or loss from their business form. Schedule C losses trigger audits. Most of the audits we've had over the years were triggered by a Schedule C loss. But if you earn $20,000 and you have $12,000 of expenses, I would feel comfortable taking the full $12,000 of expenses against that income. Travel and lodging for continuing education deductible. Yep, that's as long as it's ordinary and necessary. If you go and you stay at like a $2,000 a night hotel that's close to the continuing ed, I'm not sure that would be ordinary or necessary. But so then you'd have to figure out what to do there. Okay, if the assignments are more than a year, you have to get back to your tax home. Once you don't return to your tax home and begin working there, you become a transient employee. I mean, a transient worker, and this temporary job assignment is lost. What was the website? It was GSA.com. Let's just take a quick look. GSA.gov. It's right here. GSA.gov. It's maintained by the federal government. So, right? Is that okay, Vicky? You got it? And they actually, it's amazing. The government made things easier with the deduction and then by putting this website together. Is malpractice tail coverage deductible? I would say so. If the years you have 1099 income, because you're getting that. So I guess you buy the tail the last year you're working. I would think so. That would be ordinary and necessary because you can't be uninsured. Fees like fingerprint. Yeah, anything that goes along with the licensing would be deductible as long as it's not your first license. If it's enhancing your skills or maintaining your skills in your current trade or business. If I'm on a long assignment, if you live and work in one city and you go somewhere for a year or less with the intent of returning back to where you were living to work, all the travel expenses back and forth during the time that you're working in the second city would definitely be tax deductible. If I'm being paid for rent and car costs, no, definitely not. So you can only deduct unreimbursed costs. So if you work for a locums agency and they pay you your whatever you're supposed to earn per hour or however it works, and then they also reimburse you for those costs, that's tax-free money they're paying you, but you can't deduct those costs again. Okay, a few more. I live in Europe and pay Medicare premiums and health premiums in Austria. I would think so. Ordinary and necessary. If you need to have both. Can I lease my car to my business? Oh boy. No, but you don't need to. If you're an unincorporated business, you can write off the business use percentage of the lease payments. Can you not get insurance and interest on your automobile? Those are both expenses if you base your deduction based on actual expenses incurred. Okay, we'll try to get to some more of these later. Okay, ordinary necessary. That is the key. Okay, retirement accounts, health, okay, estimated taxes. So when you work for somebody, as an employee, they withhold taxes from your pay, and hopefully they take out enough taxes. When you get paid as an independent contractor, anybody who's done it, you see that there are no taxes being withheld. So it's up to you to pay enough taxes to basically avoid being penalized. But then also you need to have the money to pay the taxes. The easiest thing to do is just to submit quarterly estimates on a quarterly basis. Now, the due dates are kind of a little bit funny because it's not every 3 months like you would think it would be if you paid something quarterly. So the first quarterly estimate is due April 15th for all the money you earned through March 31st. The second is due June 15th for the money you earned through the end of May. The third is September 15th for the money that you earned through the end of August. And then the fourth one is actually January 15th of the following year for all the money you earned through December. I have a link here to the estimated taxes. The IRS, they have some good information. The IRS website's actually very, very nice. They have a lot of information, but in the slides and in the handbook, there is going to be this link will be there, and there's plenty of information about paying estimates. It's not that hard to pay estimates. We actually tell our clients to pay it online. If you go to irs.gov, you can make a payment. It comes right out of your bank. You're not mailing a check. For a while during COVID, the IRS wasn't even opening their mail. And then there's fraud issues and all this stuff. So it's just easier to pay your federal and state taxes online. All right. So So I do want to point out that when you work for an employer, they withhold federal taxes from your salary. They also withhold Social Security and Medicare taxes at a rate of 7.65%. And then the employer matches those taxes that are withheld. So the government gets 15.3 cents for Social Security and Medicare taxes for every dollar you earn. It actually goes up a little bit if you make more than 250,000, more than 200,000, something like that. If you're self-employed, as part of paying your estimates, you need to pay the federal taxes due on your net locums income. You also need to pay this 15.3% Social Security and Medicare tax. When you're self-employed, it's called the self-employment tax, and you pay that tax as part of filing your federal income taxes. So if you're in the 25% tax bracket, you need to pay 25% of the net earnings for your federal estimate, but you need to increase that for the 15% you're paying for Social Security and Medicare taxes. That's why you want to do these other things like deduct your professional expenses, contribute to a retirement plan, contribute to an HSA, because paying 40% of every additional dollar you earn is a lot of money. You need to shield some of that income by doing some of these things. Basically, you want to pay enough to avoid being penalized, and then you're going to earn interest on the rest of the money. So situations where your income is increasing year over year, you'll base your estimated tax on your prior year's tax. So if your income's less than $150,000, as long as you pay in your prior year's tax during the year with timely filed estimates, you won't be penalized no matter how much you earn. If your income is $150,000 or higher, you need to base your estimates on 110% of your last year's tax. But if you pay that in, and then when you do your taxes, you owe like $50,000 more in taxes, you won't be subject to any penalties. And these days, with interest rates at 5%, you can earn a little bit of interest, or a good amount of interest, by planning your tax payments accordingly, and just being prudent about it. So you want to pay enough so the government doesn't charge you extra by charging you an underpayment penalty, an underpayment of estimated taxes, and then you take the rest and you put the money aside. I think what we recommend is for our clients, when they earn this type of 1099 income, we recommend that they put away about 40% of the income less expenses. So if you put away 40%, you'll have enough money to cover your taxes. Hopefully you'll have a little bit extra at the end of the year, which will be a little bit of a refund, I guess. If you're spending, or you're using all 100% of what you're earning as a locums, unfortunately, you're probably going to end up with an unpleasant tax surprise next April when you file your taxes. So you want to be careful with that. All right, then there's the QBI deduction. This came up in 2018 as part of the Trump tax law changes. It's pretty good. So if you're self-employed and your income is below 182 if you're single, or 364 if you file a joint return, you get to claim a deduction equal to 20% of your self-employment earnings. It's actually your net self-employment earnings less how much you put into retirement, how much you're deducting for your health insurance premiums and things like that. But it's a nice deduction. So it's just make sure to do it. If you have any tax software, they're going to pretty much automatically do it. Once your income exceeds the 182 for an individual, or 364 for a joint filer, then what happens is it starts to phase out, and the phase out is 50,000 for individuals and 100,000 for married couples. It's just something to be aware of. It helps self-employed people save some taxes, and it really does. Like if you can deduct 20% of your self-employment income, that's good. So it's called the QBI deduction, just something to be aware of. Your tax preparer, if you use somebody, they'll know about it. TurboTax knows about it. It's at this point, it's been around for 5 years. It's pretty basic. So let's talk about some planning tips. If you are earning some 1099 income, getting paid as a locums. So first, it's the 40% rule. And I mentioned that a few seconds ago, but if you put aside 40% of your net earnings for taxes, you should be in good shape. Put into a separate money market account. These days, money market accounts are paying about 5% interest. So you put your 40% that you're setting aside into that account, you earn your 5% interest. When it comes time to pay the taxes, you pay the taxes out of that account. If you see that account's growing, you're probably going to owe money next April. If you don't have enough money in the account to pay your taxes, then you might need to revisit how much you're supposed to pay in quarterly estimates. You shouldn't need to pay more than 40% of your self-employment earnings. Okay, so you set aside 40%, you submit quarterly estimates, very easy to do. If you go to irs.gov, there's a way to make the payments. So when I started this, the webinar, we started by saying you get to write off your unreimbursed professional expenses directly against your 1099 income for the locums work. You definitely want to have a good system to keep track of the expenses. The first and best way is to use a personal finance program like Quicken or Mint, where it keeps track of all your bank activity and all your credit card activity. And if you categorize things correctly, you can generate a nice, easy P&L at the end of the year, so you don't lose track of anything. Some people use a dedicated credit card and they only make their business-related purchases on one specific credit card. At the end of the year, hopefully it has a nice summary, and you can just base your deductions based on the credit card. There's a handy spreadsheet that we have. I think this one's pretty dated. Where is it? So this thing here, I think it's from 2016. Okay, so the mileage isn't going to be right, but otherwise it's a good way to keep track of all this other stuff. And there'll be a link in the guide that you can use. So that takes a little bit of work. The spreadsheet, and the worst way is just keep a folder and put your receipts in over time. There's no way you're going to keep track of all of them. I meet with a lot of people to do their taxes, and they have this 1099 income, and they want to claim expenses. If it's not written down, they're not going to remember. And sure, you can estimate it, but you're better off. It's easy enough to keep track of this stuff that you don't need to guess. So keep good records. Take advantage of your tax shelters. So it's the retirement account and the HSAs. The money that goes in is tax deductible. The money that remains in those accounts grows tax deferred. You're investing the government's money that you're going to pay back later, but you keep the compounded earnings of the government's money. You're going to get a nice 49% return on the first year anyways, on the money that goes into those accounts. It's great. And this stuff's complicated. So finding a tax professional, even one that has a focus on healthcare, is always good. It's just the rules are too complicated, and they keep making them more and more complicated. Okay, state taxes. When you work as locums, this actually is a little bit complicated. It's not that complicated. So here's the rules. So first, when you work as a locums, you first pay taxes to the state where you work, okay? So if you live in one state and you work in another state that has an income taxes, you first pay taxes to that state as a non-resident. So you are only taxed on the income earned in that state at their tax rate. The second thing you do is you calculate the taxes in the state where you live. Now, there's no double taxation. So you calculate the taxes in the state you live, and then you take a credit for the taxes you paid in the state where you worked. Essentially, what happens is you end up paying taxes based on the state that has the higher tax rate. Okay, so I can go through the example, but in Massachusetts, the rate's 5%. Rhode Island, the rate is 7%. So if you live in Mass and work in Rhode Island, you pay 7% to Rhode Island. The 7% Rhode Island tax will completely offset the 5% Mass tax. So you would owe no Massachusetts income taxes on that income. You pay it all to Rhode Island. If you live in Rhode Island and you work in Mass, Mass will have you pay a 5% tax. And then when you do your Rhode Island tax, they'll calculate the tax at 7%. They'll subtract 5% to what you pay to Mass. So you'll owe 2% to Rhode Island. Either way, you pay taxes based on the higher tax rate. And last but not least, let's talk about S corporations, because S corporations, we've seen people doing locums who set up S corporations, and I'm not sure that's the right thing to do. It's going to be way too much work, way too much fees, and there's not going to be much of a savings there. When we work with people in our office, and we work with a lot of successful physicians and dentists and dental specialists and other and mental health practitioners, behavioral health, whatever you want to call it, and a lot of people who make a lot of money, what we've figured out over the years is unless somebody's net income is going to be over $400,000, if they have no other employees, and this is important because If they form a corporation, they need to start doing payroll just for themselves. If they're going to make less than $400,000, the fees and the costs and the headaches associated with forming the corporation are going to exceed any of the benefits. Now, if you compound that with the fact that once you set up a corporation to do locums, and you're going to work in a bunch of states, every state you go in, you need to register your corporation to be able to work and get paid in that state. And then you need to set up the payroll to withhold state income taxes and pay state unemployment taxes for every state you work. It's a nightmare, a nightmare. So if you're going to make it, less than $400,000 after deducting your expenses, I would recommend against setting up an S corporation. And from a legal liability standpoint, there's no entity protects healthcare professionals from malpractice. The legal liability protection protects you if you enter into a contract and the LLC enters into a contract with somebody else. The LLC can't make good on the contract. You personally wouldn't be liable for paying off the lease or whatever. But that's never going to happen because you'd have to sign personally for everything anyways if you're just a little LLC. Okay, so what I'm telling you, and based on my experience, if you're going to do locums, do not rush and set up an S corporation. You can set up an LLC, which is a limited liability company. The potentially there's some limited liability you're going to get. I'm not sure what that would be, but you'd have to talk to a lawyer anyways. But from a tax perspective, it's much easier. You would just be a sole proprietor in all these different states. Let's see. So if you form an S corporation, there are some advantages. You can pay yourself as S corp distributions instead of as salary when you save a 3.8% Medicare tax. Maybe you save some Social Security taxes. There's a way to get around the $10,000 limit to state and local taxes that you can deduct as an itemized deduction. So there are benefits. But the cost, you have to set up payroll. You have to set up payroll for every state where you work. And if you use a payroll service, that's going to get expensive. If you do it yourself, I don't know how you do it yourself. It'd be too complicated. Your S corp tax return becomes very complicated. You need to do this thing called apportion your income to all the different states where you work. It's a nightmare. But talk to a tax professional. If it's not us, maybe somebody else feels like setting up an S corp is the way to go, and you can take it from there. But we're not a big fan of that here. It's just way too much work, and there aren't enough savings to make it worthwhile. Okay, so what time do we got here? We got like 5 or 10 minutes. If you want, I can scroll through some more of these questions. And let's see. Okay, so employer would rent. I want to move away from the employer. Whatever. What about traveling to the airport? Yes, travel to the airport because that's part of travel. Driving to the airport and parking at the airport is a travel expense. My locums pays my expenses. I have no medical insurance or deduction, so I have been taking the standard deduction. Well, when you have the unreimbursed professional expenses, that's not an itemized deduction. That's a deduction you take against that income on a different tax form called the Schedule C, the profit or loss from business. So you can take the standard deduction for when you calculate your taxes. You can still deduct whatever expenses you might have against your 1099 income. And if you're traveling, I don't think you're getting reimbursed the daily rate for food. So everybody should at least be able to deduct the per diem rate. I might be wrong. And if Barton is paying you whatever it is per day to work, then that's even better. I have both the W-2 and a 1099. Can I max out both the 401k and the SEP IRA? Yeah. So if you max out the retirement where you work as an employee, and then you have your 1099 income, the rule is that these two businesses can't have common control. So let's say you own more than 50% of a medical practice, and then you also do some locum stuff on the side, and you own 100% of your locum practice. Anytime there's more than one business that share ownership of more than 50% with the same people, they're seen as one entity for retirement plan purposes. But if you work at a hospital, which you don't own, and you're doing this locum stuff, yeah, you should be able to max out the retirement plan at the hospital and also max out a SEP IRA. if you put money into the 401k or 403b at the hospital through salary deferrals, then the solo 401k wouldn't work for you because the salary deferral is actually limited to 22,500 last year, 23,000 this year, an extra 7,500 if you're 50 or older. You have to combine those for all the locations. But if you go, well, let's say the situation where it's a married couple and one person has a great job at a hospital, makes a lot of money, maxes out their retirement. The other person makes 50,000 as the locums. That person can put 40,000 or so into the solo 401k. So it's a great opportunity. If you work only a few weeks at a locums in 2023, but in 2024 you intend to work 14 weeks, does that mean you work? No. Does that mean you work greater than a year? A year is 52 consecutive weeks. It's not a calendar year. It's 12 months of time. Can we get the slides? Yeah. Right. They're gonna
Yes.
Stacy will have that. Stacy, my clock isn't on. What time is it?
You have 8 more minutes, so you can, yeah,
Oh,
you have
okay.
8 more minutes. Yeah, all the slides will be available following this. What we're going to do is we're going to edit the video a little bit, and everything will be available on our YouTube channel as well as on our website. And then anyone who signed up for the webinar, I will also send you a link to everything in an email.
Oh, thank you. Okay. Is there an age limit on contributions to retirement savings? It used to be, there isn't anymore. Any year that you have 1099 income, you can put money into a SEP, a simple solo 401k, whichever one you have set up. Well, there's me. How'd that happen? What is the limit on contributions for a SEP IRA? The limit is, if you're self-employed, if you don't have a corporation, it's 20% of your net self-employment income. So it's your the amount of the 1099 less the expenses you're going to write off against the 1099. Then there's one additional little part of the calculation, which the program will do automatically. So if you make 100,000, you have 20,000 in expenses to write off against that income. And you're self-employed, you can put away just under 16,000 into a SEP. If you do set up a corporation, the amount you can put into the SEP IRA is 25% of the wages that you pay yourself through your corporation. Over time, is pre-tax or post-tax more effective? That's a tough question. So what Erica is asking is, so each retirement plan, actually starting this year, each retirement plan does have this. They have the pre-tax option where you put away the money, you save taxes when the money goes in, you pay taxes when the money comes out, or you have the Roth version where you forgo a current year tax break in connection for a promise from the government that you can take that money out tax-free later. Which one makes more sense depends on a lot of variables. The higher tax bracket you're in, the more expensive it is to forgo the current year tax bracket. Some people talk about income tax diversification. So they want financial planners want their clients to have some money in pre-tax, some money to have Roth accounts. Yeah, there's no easy answer to that question. If you work a regular job, W-2 and a locum job, can you have a SEP IRA? Yes. Yeah, so as long as it's not common ownership. What's the web address for the retirement webinar he had listed at the bottom of the page? I guess I'm retirement. Oh, okay, here we go. Let's see. I think this is on my accounting firm website. This is an article. Oh, yeah. My brother actually put this together. It's a short summary of the different type retirement plans. All these links are going to be active in both the guide and in the slides that you get. So there's SEP IRAs, solo 401ks, simple IRAs, 401k, and he doesn't go into defined benefit plans. But defined benefit plans, like if you make a couple 100,000, believe it or not, you can put a couple $100,000 away into a pre-tax retirement account. Okay. I had a high deductible health plan with an HSA, then switched to a non-high deductible health plan. What happens to the money left in the HSA? The HSA has no use it or lose it issue, so the money can stay invested in the HSA. Going forward, any medical expenses your family has, you can take out the money to pay for that medical expenses, or better yet, invest the money at Fidelity or somewhere else in a nice low-cost mutual fund. and let that be another place where you have some money growing tax deferred that you can use later on in life when you're gonna, need to come up with money to fund your living. Once you retire, there are no pension plans anymore, so we're all gonna have to save money and then live off that money later on. Does your HSA contribution or solo 401k money come out of from the LLC or S Corp W-2? Oh boy. The HSA actually would never come out of the S Corp W-2. So the HSA would be funded personally. The 401k would be funded through the S Corporation. I've been traveling to multiple different locum sites located in different cities for greater than a year. I normally travel from my home office where I perform primarily administrative and consultative work. As long as you go back to your tax home and that's where your family is and that's where you're doing some work, that resets the clock, and then the next one, then you can go back to the next place for a year or less, and it counts. Once you go from place to place to place, you are no longer, your tax home changes, you become a transient worker, and you lose out on all these deductions. You have to reset your tax home every once in a while, within at least once a year. As a contractor for the health savings and retirement plan savings, what would I have to produce during filing? Nothing. If you ever get audited, you'd have to show records that you made those payments that you're deducting on your tax return. The tax system, as we may or may not know, it's a voluntary tax system. Voluntary compliance, except the IRS makes sure you follow the rules, and they put you into jail if you don't follow the rules. But at its essence, it is a voluntary tax system. Is gas deductible when using a rental car? It is. So with the rental car, there is no standard mileage deduction. It's based on the cost of the rental car and all the other fees associated and gas. I had a W-2 from January through August and a 1099 for the whole year. Does that change anything? No, like if you have unreimbursed business expenses and you have a 1099, take the expenses against a 1099. The IRS, they're very form over substance oriented. They don't know which month you worked and which month you had the expenses. If the relationship between the expenses and the income looks right and you're not showing a loss, then why not? How much can you put into an HSA of over 55? It's if you're single, it's 3,850 plus 1,000. If you're married, it would be 7,750 plus 1,000. And then if your spouse is 55, it would be 1,000 for that person in another account. So you can't put 9,750 in one account if you're married. It would be 8,750 in one or 1,000 in the other, or any other way you want to split that up. Oh, malpractice, definitely. Malpractice insurance premiums is definitely deductible. That would be ordinary necessary. And there's a whole list. It's dues, licenses, conferences, computer stuff, your cell phone, but definitely malpractice insurance. Life and disability insurance, no. Life and disability insurance are never tax deductible, but malpractice would be. Okay, a few more. Medicare supplement, I think it's all the Medicare. That would count for you and your spouse. Our quarterly tax is mandatory. Yes, there's a calculation that's made, and if you don't make quarterly taxes and you owe a lot of money on April 15th, you would pay an underpayment penalty. Now, in prior years, the payment penalty was pretty low because interest rates were so low. We're going to be seeing bigger underpayment penalties now. So so they are mandatory. But if you don't do them, then you're just going to owe the government a little bit of interest when you file your tax returns. Can you take advantage of any of these deductions if you also have a W-2 employee? Yes. So if you have expenses, you take the expenses against the 1099, as long as it seems reasonable and you don't show a loss. Is per diem 7 days a week, even if you only work 5? So the per diem is any day you work, and then it's actually a travel day before. So if you travel on a Sunday or you travel on a Saturday, that would count. And if you spend a weekend and you work Friday and then you work the following Monday, the weekend, that the per diem would count. It's still part of the business, the trip. Oh boy, I think I hit on the S Corp. This must have been answered. Okay, Stacy, is that it?
I think that's it. Yeah, I copied all of the questions down here, so I'm going to group them up a little bit, and then we also have a pretty extensive FAQ section on our website from the previous years. Some of the ones that are some of the stuff data might be a little bit old when it comes to gas how much you can expense on the gas side. A lot of it probably is on our website. So I'm going to take a look, double check. And then if there's ones that are not answered, I'll reach out to Andrew and update those FAQs. And then I'll send a link in the email that you'll all be getting with the link to the FAQ section as well.
Great. So I think I have my contact information in here. I got sidetracked. Whoops. Here's me. Do I have it? Yeah, you don't want to call. Is my email anywhere? No.
I'll put your email in the follow-up email too, Andrew.
Okay, so I will ask, yeah, so if you have a question, I'll try to answer them. I typically get a handful right off the bat. So it's tough because I have all my client work too, but I'll try to get back to you as quickly as I can. And we do work with a bunch of locums here at my firm. So if you think you'd want one of the tax accountants to help you out, then you can call.
Andrew, you are accepting new clients and you are accepting clients nationwide, correct?
Yep, we're helping out people nationally. Here's the phone number to call. There are some states actually we can't help because they have a local tax, and that's Pennsylvania, Ohio, and Indiana. They have just quirky rules, and we don't know the local rules. You're going to want to go to someone who knows those rules. But otherwise, if it's a state that just has one state's income tax, we can help you. If we do help you and you live in a state and you work in another state where there's reciprocity, which means you only tax on your home state, just let us know that you know that, so we can because we know what we know, and some stuff's just a little bit specific. But thanks so much, Stacy. I hope everybody found this to be an informative hour-long webinar.
Thank you so much. Thanks, everyone. Have a good day.
Thanks.
Bye.
Bye.